So if the stock market crashes in, say, the next few years, which is definitely possible given how overvalued everything is right now. Remember, we're at the second highest valuations in history, second only to right before the dot-com bust. At some point, it's going to happen. So does that mean that the people who go out there and they buy a long volatility ETF, maybe something like the UVXY, will they make millions of dollars when the products get back closer to their previous levels? If we look at the UVXY over just the last 5 years, it's trading around $10 today, but just a few months ago it was over $50. And just a few years ago it was over $500. If the market crashed and it got back to where it was just a few years ago, that's a 50x profit. A $25,000 investment becomes $1.25 million. And if we adjust this scale here to show the full history, let's do the max available and make it weekly so we can see it. Here we are today at $10, and that right there says $122 billion, billion with a B. So according to this chart that anybody can see in any trading software, this is Thinkorswim, the UVXY has gone from $122 billion to $10. It does seem like there's a tremendous opportunity here to make money, and this is why I get so many emails from people asking this exact thing. How come we don't just put a small amount of money in the UVXY and wait for our 50x profit? The next time the market crashes, we'll be millionaires, right? You can probably tell from my sarcasm here, no, that's not what's going to happen. Let me save you long volatility traders some money today. And really quick, I have also taken a break from making videos recently, so please do me a solid and hit that like button so YouTube knows that I'm back in the lab making regular content. So we always have to keep in mind that volatility ETFs are not stocks. Look, if we're talking about something like Apple or Amazon, if one of those stocks has a huge drawdown during a market crash, well, it would be reasonable to expect on a long enough time horizon that it will get back to those previous highs. An example of this would be Amazon during the dot-com bust, right? People may not know this, but Amazon actually crashed 95%. If a person scooped it up near the lows and just waited, yeah, it's perfectly reasonable to expect it to eventually recover, and it did. Just 2 years later, it got close, and a few years after that, it did get back to all-time highs again. But again, volatility ETFs are not stocks. They aren't based on supply and demand. They only track the VIX futures. In the video description, I'll link part 3 of this free volatility ETF course so you can refresh your memory of how things work. But essentially, they just track the front 2-month contracts. That's it. Whatever direction the VIX futures go, that's what the UVXY does as well. So of course, if the market crashes, those VIX futures are going to spike up really high, and that in turn is also going to spike up the price of UVXY. But so what? Remember how this works. The VIX futures are constantly moving down the term structure, and every month that first contract expires. Then they all move down 1 month and it keeps going. A month after that, the next one expires and they shift down again. This is repeated indefinitely. So you can't look at the price of the UVXY from 2 years ago to gain any information. You can't even look at it from 2 months ago. Those numbers don't mean anything. The VIX futures that caused the UVXY to go down so far are gone forever, and they have no effect at all on the forward pricing. Again, if we were talking about Amazon, then of course when the price crashes, it's still the same underlying company. Same products, same employees. It's reasonable to assume it'll come back eventually. But volatility ETFs have a constantly changing structure. It's essentially a brand new ETF every single month. This is the punchline. There's no such thing as a previous price for a volatility ETF. That's a totally irrelevant number. Let me show you what I mean with an actual example here. So the biggest spike from a low that the UVXY has had in the last 15 years was during COVID. It actually spiked up over 1,200% in just a few weeks. And let's be honest, the only reason it stopped there was because the government spent trillions of dollars to rescue the economy. I could definitely see a scenario in the future where something like the UVXY spikes up 2,000%. So here's that 5-year chart for UVXY, and it's at $10 today. If we saw a repeat of COVID, that would take UVXY back to here. That's where it was only back in 2023, not that long ago. Here's the UVXY back to its inception in 2011. If the worst stock market crash in history happened this year, UVXY would spike up to about here. Do you see it? Yeah, me neither. It's barely a dot on the long-term chart of this thing. That's what we're talking about. These previous prices mean absolutely nothing. Now, really quickly, for those who are confused by that insanely high launch price, Of course, it never traded at $122 billion in real time, essentially because it decays down so consistently with a completely new set of VIX futures every single month. It means they have to do constant reverse splits to keep the price tradable. It decays down to single digits, and then they have to reverse split to get it higher. Every time they do this, it multiplies the price going back in time. So for example, it's at $10 today, and if they did do a 10-to-1 reverse split, then that would take the price up to $100 the next day. But remember, that reverse split also multiplies all previous prices by 10 as well. There's been 12 reverse splits since inception, and every time one of those things happens, we have to multiply the previous prices as well. Times 10, times 10, times 5, reverse splitting over and over again. That's why it eventually says something totally stupid like $122 billion in 2011. That is a real price, that's what the value adds up to throughout history, but in live trading, it's always been a completely normal number. The main point of today's video is to drive that point home that there's no such thing as previous prices for volatility ETFs. Effectively, there is no past. It's a constantly changing underlying asset of VIX futures, and every single month they expire. If you're trading long volatility ETFs thinking that you're going to be a millionaire, I hate to be the bearer of bad news, but minus a few spikes here and there, it is just going to keep going lower. So now you can either go to the next level of education and learn how those volatility ETFs actually function based on the VIX futures, or you can check out this video where I explain how I personally use the volatility products to make over 30% a year with tactical rotation. See you in the next video.